Hello everyone, I'm Miles. In valuation, the hardest part isn't the math, it's knowing which value to use and why. Today, we're going to learn from 3 classic problems. After this, you'll never confuse enterprise value and equity value again. Problem 1. TEV versus equity value. A company has revenue of 400, EBIT of 40, depreciation and amortization of 10. So EBITDA is 50, and after-tax net profit is 20. Equity value is 500, debt is 300, and cash is 100. Calculate 2 ratios, TEV to EBIT and the PB ratio. TEV equals 500 plus 300 minus 100, which is 700. TEV to EBIT is 700 divided by 50, which equals 14 times. PB is 500 divided by 20, which equals 25 times. Conclusion: TEV should be paired with operating indicators, such as EBIT, because EBIT is operating income and belongs to all capital providers. Equity value should be paired with post-interest indicators, such as net profit and EPS, because these only belong to shareholders. Question 2. Minority interest and preferred stock. A company has an equity value of 1,200, debt of 500, cash of 100, minority interest of 150, and preferred stock of 50. EBIT is 150, depreciation and amortization is 30, so EBIT is 180. To calculate TEV/EBIT, TEV equals 1,200 plus 500 plus 150 plus 50 minus 100, which is 1,800. TEV/EBIT equals 1,800 divided by 180, which is 10 times. Why does TEV need to include minority interest and preferred stock? Because consolidated financial statements include 100% of the subsidiary's EBIT, we have to add back the portion of value that the parent company doesn't own. That's minority interest. Preferred stock pays a fixed dividend like debt and takes priority over common stock, so it also needs to be included in TEV. So the complete TEV formula is TEV equals equity value plus preferred equity value plus minority interest, also known as non-controlling interest, NCI, plus debt minus cash. Question 3. The impact of debt repayment on EBIT. A company has an equity value of 800, debt of 400, cash of 200, and EBIT of 120. Now, it uses 100 in cash to pay off 100 in debt. Before repayment, TEV equals 800 plus 400 minus 200, which is 1,000. TEV divided by EBIT is 1,000 divided by 120, which equals 8.3. After repayment, debt is 300, cash is 100, and the new TEV is 800 plus 300 minus 100, which is still 1,000 unchanged. EBIT is still 120, and TEV divided by EBIT remains 8.3 times. In conclusion, using cash to pay off debt does not change TEV or the enterprise multiple, because both decrease by the same amount. Changes in capital structure do not affect the EV multiple. To sum up, the enterprise multiple cuts through the noise of capital structure. EBIT shows you the economic cost, EBIT removes accounting distortions, TEV should always be matched with operating metrics, and equity value should always be matched with post-interest metrics. Once you master this matching rule, your valuation analysis will truly compare like with like. In other words, apple to apple.